Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and in the world of investing. I'm Stacy Smith, and I urge that you hit the like or the subscribe button on whatever platform you happen to be watching or listening to this podcast on. It has been a remarkable year for the stock market, with the indices all up on a percentage basis, double digits. But is that true of the overall market? We'll take a look at that. And what changes could be happening in 2025 that could have an impact on your portfolio? We'll discuss that in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Carrie Coghill of Coghill Investment Strategies, also Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, and Michael Godwin of Forgasso Advisors. Thanks again for joining me for The Bull, the Bear, and You. I trust all of you have all of your Christmas shopping done by now.
Yep.
Oh, that's good. I don't. Well, I've said it before, and I have to say it again. In the 2 weeks since we last met, all three of the major closing indices have set new all-time closing highs. In fact, this has been a remarkable year. The Dow is up 16%. The NASDAQ is up nearly 33%, and the S&P 500 is on track, I think, to set its best percentage gain in its history, up 27%. Now, we're near the end of the year, so it's kind of time to reflect and also to take a look forward. So let's reflect first. So, Michael, lead us off. Why the big surge in the markets this year?
Yeah, thanks, Stacey. I'm not sure it's the best year ever, but I know it is on pace to hit the best year in at least the last 20 years. So the S&P 500, which I think we should point out is not the market. There's a lot of other different asset classes out there, whether it's small cap stocks, international, emerging markets, et cetera. But I get that we as investors tend to focus on the large cap U.S. equity markets. But that is up, as you mentioned, 27% so far this year. And I'm kind of fond of saying that there's really only two ways that the stock market can go up. One is if the earnings that those companies generate continue to increase, and the other one is if valuations or the price that investors are willing to pay for stocks go up. So this year, earnings have contributed about 11% of that 27% of the increase in the stock market. And then valuation expansion has contributed to the other 16%. So stocks have undeniably gotten more expensive as the year has progressed. We're sitting at valuation multiples that are ex-COVID as expensive as they've been since, I think, the early 2000s. So what's kind of driven that, Stacey, is your question? I mean, the tech sector continues to do very well. That's up about 40% or so this year. And I think that's almost entirely driven behind the AI revolution or the AI hype, whatever we want to call it. As I think, it's yet to remain to be seen whether these actually really revolutionize productivity in America. The other reason would be the market simply got more clarity after the election last month. I think investors looked very favorably to what a Trump presidency might do for companies, and particularly the U.S. equity markets, whether it's cheap financing that's going to become more available or less regulations. I think that's going to be a relatively friendly business environment for U.S. companies. And lastly, the Fed has embarked on an easing cycle. We saw inflation has come down, although I think inflation will remain more sticky than most people anticipate. The Fed has begun cutting interest rates, trying to stimulate the economy, trying to keep the unemployment rate pretty subdued. And I think that's all contributed to a very positive stock market environment this year.
All that being said, you did mention correctly that the AI thing has had to pretty much carry the day. I heard a statistic of the recent market moves where the goods producers in the United States have actually been flat to down lately. And that I find to be interesting. And I personally see that this market has been struggling in here a little bit. Doesn't look like it, but I think the market in general is not doing as well as the indexes look. You're agreeing with me, Kim.
I have to agree with you. Yes, absolutely. As somebody who has exposure to tech for sure, but then other areas of the market, the other areas of the market really feel flat. And I think there's a lot of reasons for that. The lower 2/3 of the pyramid of economic, um, the economic pyramid is suffering. I make myself go to Walmart to shop, and I eavesdrop, and there's a lot of family discussions that go on every week about what we can afford, and no, you can't have that toy or whatever. And I know a lot of that needs to go on, like for a healthy dynamic. Children don't get everything, but there's a lot of I feel pressure when people are shopping for life's necessities, because they have gone up incredibly, especially, and I can't figure this out, anything having to do with a cow, right? Like dairy products are really expensive, beef is really expensive. Not sure what's going on there. I agree, though, that there may be a bubble in AI. Well, we will see. The Microsoft offering doesn't seem to be being taken up by people to pay a $30 extra a month for access to OpenAI through Microsoft's portal. So you always have to ask yourself in any new technology, where's the value? And I think we're seeing a lot of value in the areas of media where we're being served up stuff to keep us on media. Whether that's healthy or not, I don't know, but I'm pretty sure it's not worth hundreds of billions of dollars that the major players are spending on developing this thinking machine. But yes, it's been, if you look under the hood, it's been a story of several markets. And I think maybe Carrie might add to this, because she's been somebody that's very much into asset allocation and spreading the love around the world. But the other areas of the world have done not that great, including, Europe. They have really lagged. So if you have a lot of exposure to outside the US, maybe your portfolio statement doesn't look as great.
So, yeah, I'll start there. We have been extremely underweight international. And in fact, until maybe 18 months ago, we were out. And if you go back and you look at the S&P 500 compared to the international indexes going back since the beginning of the S&P, there's been no value in owning international. I think before the 90s, like 70s, 80s, maybe through mid 90s, there was a benefit of diversification, that when the US market wasn't doing well, we could get some performance from international. And for individual investors, that's very important, especially for people taking distributions. It helps to smooth the performance. But as this world has become more interconnected and globalization has taken over, we're not getting that non-correlation that we used to benefit from in the 70s and 80s. So, I think the market right now is, I was at one of the malls, believe it or not, over the weekend. They still do exist. And for the first time in a long time, I couldn't find a parking spot. So that's a good thing. Now, the question is what's going on inside, like how many specials, how much discounting is going on. The way we're really gauging the economy as far as the consumer is concerned is really through credit card usage and looking at those delinquencies, which are starting to creep up a bit. So, I do think that it's the market's a little more fragile than we think. And Michael pointed this out at the beginning of his comments. If we've had 16% expansion, that means we have some vulnerability, right? It wasn't just earnings driving prices. As far as AI is concerned, it's kind of weird. I think that Kim and I maybe have shifted. I'm a huge fan of AI. We use it constantly. I use it in my personal life constantly. The other day, I have mushrooms in my refrigerator. What can I make with it? Create the shopping list. I mean, I use it all the time. But I think this goes back to a time frame. If we look back to the internet stocks, 1999, granted the internet stuck, but there were a lot of companies that came along the way that don't exist anymore.
Yep.
So I think that it's going to, we're just going to have to tread a lot more carefully. Valuations are high. There's, is AI for real? Some of it is, some of it isn't. And the other point that I think Michael mentioned is if we do see lower amounts of regulation, good and bad. You really, as an investor with less regulation, have to really do your due diligence.
We want to get into part of that in a minute here. I do want to ask this question, though. I did a little bit of research. I'm not the historian that Michael is as far as the markets go. So correct me if you need to here. But since 2017, when Trump became president and took office, we've seen double-digit gains in all of the indices, with the exception, I think, of 1 year when we had a decline in the entire year. Twice the Nasdaq's been up 43%. It's not up that much this year, and the S&P 500 has been up 26%. I think that's this year. So reflecting back on the last 8 years, given everything that you've said, it's not just AI this year. It's been happening. This big surge in the market, this bull market run, has been going on for at least, well, the bull market, I guess, is what, since about 2009 or 10, something like that.
It has, and Stacy, I'm not like, that's nice of you to say. I'm not like the David McCullough of of the markets or anything like that. But that's
well, you don't quite have his voice either. I mean, that was an unbelievable voice.
You're right. It's not all AI driven, but it is vastly driven by those types of companies. The Magnificent Seven, the FANGs, all those nomenclatures that we've heard over the past decade. Those tech companies have driven a very large amount of the outperformance in the U.S. stock market. I mean, the top 10 companies now account for more than, I think it's like 35% of the S&P 500.
Okay.
A decade ago, it was much lower than that. I mean, NVIDIA alone has grown an astronomical amount over the past, not only 1 year, but past 5 years as well. And that performance has really helped catapult the S&P 500, the NASDAQ, whatever index you want to look at, the large cap side, to these extraordinary heights. So the vast majority of that outperformance is being driven by those top 10, 15, 20 stocks or so.
So if you look at the S&P, it's up about 28.5% year to date. If you look at it on an equal weight basis, meaning every company has the same impact to performance, it's at 17%. So, we've got a good 10% that's solely being driven by these companies.
And I have to respond to your we're flip-flopping on AI. I think that's interesting because I came from, the reason why I sit here is because I worked at AI companies that couldn't fulfill the promise of adding value for the projects that they did for their corporate customers, right? So that colors my entire thinking. While I understand the allure of what we're actually getting is just a better search engine, right? Like, what should I do with the mushrooms? Look at my shopping list. What do I need? Like, I get that part, but what are you paying for it? You're giving up your information. You're giving up your privacy for access to that. Somebody else is paying for it. And I think about how much not only has been spent in the last, we'll be kind and say 6 years on AI, because it's been ramping. OpenAI was working on the down low. Certainly Tesla has spent a lot of money. Their autonomous driving is essentially a specialized AI for driving, right? So there's been a ton of money spent, but I don't see individuals and companies paying for it. And to me, that's a really big red flag. I think there was a show called Now What Would You Pay, right? So that's my concern, is how long can these companies continue to spend and just promise about getting return? And that's kind of what we had in the late 1990s, where You know, we laugh at the sock puppet of pets.com, but darn it, Chewy delivered my dog food on a Sunday. Look at that. So the promise of pets.com came, but not the earnings to save it. I'm very keenly aware of that. And I don't know when the spending will stop. Nobody does. And we'll get to that in a minute, because that might be in the next segment or the next line of questioning.
Well, we've kind of merged two segments we were going to do already, and that's, reflecting back and taking a look forward here.
Yeah.
But if indeed these indices are weighted the way they are, is there an indice that the average person can take a look at and get a real feel for what the entire market is doing?
Let me say something as a no longer participant in the industry. When I did participate in the industry, we never, on purpose, used the index as our guide. We talked to people about what they needed to accomplish with their money to achieve their investment goals, and we created a target rate of return that was based on that need. And we allocated assets accordingly to try to achieve that targeted need without regard to what the market was going to do, because it's a fool's errand to try to figure out what the market's going to do next. No one knows. It will go down someday. We're overdue for a correction. We can be overdue for years before we have a correction. I mean, so
if nobody knows what the market's going to do, how do we know that what you were telling your clients, these particular stocks, were going to be the ones that were going to do well?
Well, it's not particular stocks. It's an asset allocation. And you have
Well, you have particular stocks in an asset allocation, don't you?
But you have historical averages of what things have done and why. You can measure those historical averages and, most importantly, why, to see if they're applicable today. We can look at what's happening in the future, like AI, and was it last week or 2 weeks ago? I'll just throw this wrench into it. Alphabet came up with their quantum computing thing that's like it's something that would take 100 years to calculate, and I made that up because it's an incredible number of years. And this quantum computer did it in 15 minutes. And that I don't even understand. I can't even wrap my brain around this thing. I talked to a tech person friend of mine who said, well, quantum computing is like being in two places at the same time, which totally boggles my mind. And heck, what we are doing right now is magic. I can't even imagine what quantum computing is. It sounds like beam me up, Scotty.
So, Stacy, let me answer your question, and then I'll pile on to what Frank was saying. There are index funds out there, or funds that do track, like Vanguard has funds that track an equal weight index. So you can invest in that if you choose. But to Frank's
does
point,
it do well?
Excuse me?
Does it do well?
It tracks an equal weight index. So if you were looking, I don't know the specifics of exactly what those funds have tracked, but it will, what they performed this year, but they should align with an equal weight index.
Okay.
But to Frank's point about asset allocation, that is for all of our clients. We are, think about the process. Client comes in, we talk about their goals, we assess their risk tolerance, we can go and develop an asset allocation. This is how much you should have in stocks, this is how much you should have in bonds, this is how much in large cap growth, like do it all. And there's software for that. It's what we call portfolio optimization. If we know someone needs a 6% return to retire comfortably throughout their life expectancy, we test that. And that combination of different allocations into different types of stocks and types of bonds, that mix is very important. I often kind of use the example of, baking a cake, right? You need all these ingredients. And what I find to be really interesting is, it's funny how a client might come back and say, oh, well, this sector didn't do well, should we sell it? And my answer to that is, if we were baking a cake and the baking, you just can't pick out one item. If you look at baking soda, it's essential to the cake, but you wouldn't just eat it alone. So we have to look at portfolios as portfolios, not as individual pieces. We just want to make sure we have the best baking soda and the best flour. And that's really where the individual stock analysis comes in. But that's like the last step. So, and it has a lot to do with someone's risk tolerance as to whether we're going to want to own some of these companies that may have more volatility versus not.
I like that, Carrie. I'm going to use that baking analogy if you don't mind.
Yeah, it'll look good coming from you.
Oh, yeah.
I mean, I don't want to make
Mike-
the assumption you're not like baking Christmas cookies every night, but
Mike, have you ever baked a cake?
Today? No, I'm just kidding. I have not. I don't think I've ever baked a cake.
So piling on here, because I am the stock picker, what I think people get caught up in is gaming, right? They think that the market, they're playing a game and they want to win whatever that is, as opposed to owning a collection of assets that are going to provide for them in the future. And I hate to get asked at parties, give me a stock pick. What's going to be a big winner? Well, you know, what I could do that. But I'm not going to do that because I'm encouraging people to think about stocks like a lottery ticket. And it is not. It can be played like that. But, you know, I buy the occasional lottery ticket, but I certainly don't benchmark my whole future on it. So there you go. That's
you bench
enough
any
about
part
that.
of your future on it.
I'm sorry?
You bench any part of your future on it.
Yes, my horse owning, my desire to own a horse, because I don't actually want to spend money that I have earned on something that can throw me off.
Now, I don't want to continue this too long here, but I do have this question, especially for Carrie. All right, you're talking about your asset allocation. You're talking about how you formulate, you know, a number of stocks or bonds and whatever else you might have. You're basing that, I'm presuming, this model that you use for whatever, as you pointed out, someone needs a 6% return every year. You're basing this on historical data. Am I correct?
Not solely.
yes. And there is first of all, one thing I want to correct because I think it's important. I think you in that sentence said 6% every year.
Oh, no,
It's just-
if I did, I'm, yeah.
6% on average
Yeah.
over time because it's never going to come 6% a
Right,
year.
right.
But we all know past performance is no guarantee of future results. Very important. However, what we're looking at when we're doing our analysis, what our software will do, we can look at it two ways. We can look at it with historical returns or we can look at it with projected returns. We're always looking at it with projected returns, which includes in its analysis where interest rates are, where growth rates are, and where valuations are. So it gives us a little bit of a better indication of, you know, what we may experience. And that really matters because, you know, what happened over the last 5 years is not going to happen over the next 5 years, even the last 10 years. So one of the things, if we're looking at work, like if a prospective client comes into us and they give us their financial plan, the minute we see that their results were based on historical returns, we're like, no, we need to redo this. We need to look at projected returns, taking into account those things that I just mentioned.
Okay. Anybody want to add any final note to this?
I'm going to add something for Kim. Kim, when people used to ask me that question, I would say, buy a lottery ticket. It's over faster.
Well, that's good too. Yeah. Yeah. I'll use that.
All right. Well, we've kind of talked about moving forward here. Kim, do you have anything else in that crystal ball of yours that you hide in the desk somewhere?
Can you say that again? I'm sorry.
That's okay. I said we've kind of already talked about moving forward with the markets here, but I asked whether you had anything else hidden in that crystal ball that you hide in your desk that
In
you
that
look
crystal ball, I almost brought my magic 8 ball
at.
down.
Magic
So
8
I don't
ball,
have
yeah.
a crystal ball, but I do have an 8 ball. And the 8 ball's always wrong. Like it's
Right.
just a piece of plastic. Doesn't tell you anything. Anyhow, do you remember those? You know, you'd
Yes,
ask it. Okay.
absolutely. Yeah.
I agree. I think it's either with Michael or Carrie talking about changes in regulation that can and probably will impact many industries. And you'll have to pay attention to that. Every time we get a change in administration, it's going to change. I'm going to highlight a couple of areas. Green is probably not going to be quite as green in the money sense. So if if you have a large exposure to EVs and solar and things like that, I might rethink that. Just look at what the focus on the administration is, and make your changes accordingly. Don't go all to cash. Don't be afraid. These are just common sense. Where do you think the money is going to be deployed? And luckily, we have a prior administration track record here to go off of. And I think, again, regulation is probably the biggest focus, and making the government somewhat smaller, which probably, oddly enough, benefits technology firms and old technology, maybe some AI, but mostly things like databases and companies that sell canned, out of the box software. I think from my days being a software engineer and doing custom applications, the government runs on custom applications, not really all that much out of the box. So I'm thinking that the DOGE people, the Department of Government, what is it? Efficiency, that they're going to want to get as much out of the box sort of software doing things for the government. That might be a good place to go hunting.
Interesting.
That's it.
Okay.
Yeah.
Great. Well, you kind of touched on this and talking about looking forward. So, Carrie, as you've just indicated here, you want a asset allocation, a multifaceted approach to investing. So, coming up in the coming year, what do you see as something that could impact someone's portfolio?
Well, I think that, we're really looking at what's going to happen with these tariffs. I think that one of the things that I'm very aware of is because I found myself doing it. We're looking at portfolios, looking at areas of the market, particularly technology, that are overweight. Well, today is December 16th. I've already had a year of, people taking capital gains along the way. And I found myself saying, let's just wait 2 more weeks to trim that position. If I'm, small town girl from Pittsburgh sitting in my office, and that's my thought, how many other people out there are thinking it? Which makes me a little concerned about the volatility that we may hit in January. So one of the things that we're doing is we're looking at what our clients' cash needs will be over the course of the next year. And we're looking at raising that cash now, even if we have to raise it from, segments of the market that we wouldn't necessarily, like if you look at fixed income, for example, if I take money out of fixed income right now, like I'm not going to hit my client with a lot of capital gains because it's lagged so much. And then I can, in 30 days from now, repurchase it. So, is now a good time to be implementing strategies like that, making sure that our clients have the cash they need for 2025, because we might be headed into some real volatility out of the gate next year. It depends on the client. It depends on whether the client, what their risk tolerance is, what types of returns we're trying to target. So it's not an across the board thing that we're doing, but I do kind of get concerned that other people, Kim, Michael, I don't know, are thinking about let's push these gains into January. Be curious to get your thoughts on that.
Yeah, we've already recognized kind of gains throughout the year, and we're very, very cognizant of trying to offset any gains we recognize with tax loss harvesting opportunities throughout the year. I think you do the same thing. There are a lot of managers who wait until December to start tax loss harvesting client accounts. We try to do that throughout the year to build up those losses to offset any gains. So yeah, I think here's what I think for next year. Don't try to game the system, as Kim pointed out, right? It's very, very difficult. Unless you have a cash need or a life-changing event, then raise the cash. Kerry, I think now is a great time to do that. My highest conviction thesis for 2025 is that we're going to have a market correction of at least 10 to 15%. I don't think that's really going out on a limb. That happens far more regularly than you think. Didn't happen in 2024. And we're going to have a pullback. I mean, valuations alone kind of augur for that. And I also think that the market returns over the next 5 to 7 years are going to be quite a bit lower than they were over the past decade. Valuations, again, we talked about that a lot. They are a horrible predictor of what's going to happen in the markets over the next year, but pretty good at predicting what the market might return over the next 5 to 7 years. And given the high valuations we're at right now, I would say that the market returns are going to be lower over the next 5 to 7 years than they were over the previous 5 to 7, which maybe now is one of the times, Kerry, that you start thinking about investing in the overseas markets, the small cap markets, et cetera.
You know, the other thing I really wanted to point out before we finish here is that one of the other things that we're really watching in Trump's tax policies is what he's going to do with the SALT deduction, because there's a limitation right now on it. And SALT just means state and local taxes. You know, so your mortgage interest is included in that. And right now there's a limitation of $10,000 max that you can deduct from your income taxes. That alone, when Trump's 2017 tax decreases went into effect, a lot of our high net worth clients ended up paying more in taxes because they no longer had the ability to deduct the state local income taxes and their interest deduction for their mortgages. Now, if he changes that, I think that could really help to stimulate the housing market, which, you know, right now things are you know, people aren't moving. So I think that there's a lot of positive implications potentially to that deduction, you know, opening up a bit.
I heard last week, I read somewhere where the trial balloon that was set out for the SALT deduction was $20,000 instead of 10. Mm-hmm. Now, I'm going to tell a story about it would be 1976, so it was almost 50 years ago. I'm having lunch with my father, who was a CPA, and they were talking about the 1976 Tax Reform Act that they were debating heavily in Congress at that time. And I was fixated on these potential changes that were going to happen. And I asked my father, the CPA who spent his life trying to avoid taxes legally for people, I said, what do you think of the Tax Reform Act they're talking about? He said, did the president sign the Tax Reform Act? And I said, no. He said, when he does, I'll read it.
Yeah.
So all this is conversation. We have no idea what's going to happen in the end.
No, we don't. Michael, I do have a question for you. When you said that, and Kerry, both of you talked about volatility coming up perhaps beginning in January, and you're saying that it would not surprise you to see a market correction coming up. If there is a market, since we've already laid the groundwork here, that not all portfolios are exactly tied to what the indices do. But when you talk about a market correction, you're really talking about the indices, or are we talking about everybody's portfolio going down like that?
They're mostly tied to the stock market, which inadvertently, or not inadvertently, but is tied to these indices that we keep referencing in these podcasts. S&P 500 correction of 10%, as Kerry pointed out, everything in the equity markets generally is highly correlated. There's not as much diversification today as there was in the 1970s between the U.S. stock market and international stock market. So when I say a correction, I'm speaking of the stock market and primarily the U.S. stock market.
And Stacy, I just want to make it clear because I don't want people taking, being clear on these things, is that your mortgage interest, your SALT deduction and mortgage interest, there are different limitations on that. So, in both cases, they have limitations, and we may see that change, as Frank was saying, specifically with the SALT deduction, which is separate from your mortgage interest, but there's still some limitations there too.
Okay.
And back to the correction versus a portfolio's correction, Stacy. The
Mhm.
allocation dictates how correlated your portfolio's drop will be with a 10 or 15% correction in the stock market. If you're grossly underweight in U.S. equities, it probably won't go down much at all, unless it went down because interest rates went up and then your bond portfolio will go down because of that math. So it really depends on what happens, and using these different asset classes helps level that out a little bit, takes some of the volatility away. But that's also based on your risk threshold. If you're a high risk investor, you're going to ride that roller coaster.
Yep. Kim?
So I'm going to take an opposite view. Most of the time when we're talking about risks, we talk about what could go wrong, right? And we'll talk about big wrongs, nuclear war, war in Asia with, Taiwan being taken over. And then there's, the whole Russia, Ukraine. Does that bleed over into NATO countries? And do we all go into World War III? Blah, 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 blah. This is what we usually think about when we think about risk. And I mean, we have to think about that. I think about that. But I also think about what can go right. The unbelievable movement of the whole Middle East, the power shifting that has gone on there, that has surprised everybody. Like if you're playing Risk, you would never have imagined that happening at this time last year, right? That Iran is a paper tiger now because it spent its resources unwisely. What? And, the whole Abraham Accords where maybe Israel and Saudi Arabia patch things up enough to be trading partners. Again, what? So I would never, if I'm, and this is why I think we can't really forecast, anything because we're terrible at it. We don't have enough imagination because we focus on what are my biggest fears as opposed to like what could go right. Okay. So I don't believe in mean reversion unless you're like dropping a ball or something like that, like it's a physical manifestation. Then I'll say, sure, like flipping a coin, if you have too many heads, it will revert to tails at some point. But the market is composed of people making bets on what's going to happen in different time periods. And because we have a different mix of people and all this stuff is happening in the world, I actually think a handful of things that could go right. And we can keep on rocking and rolling with these unbelievably high returns in the future. I think America has always been well equipped to be the funder, the financer of the world because of our laws and how we can do capital formation here. Again, because of our courts, our bankruptcy courts are like no other. The business courts adjudicate like no other. So people come here to create companies, and the U.S. has expanded. And I think this is why we've outpaced all of the other areas of the world, because people come here to do capital formation, and our companies now serve the world. Even small companies. We have a little company here in Pittsburgh called Coherent. It used to be 26. It used to grow crystals for steel cutting devices, steel lasers, lasers that cut steel. And they are now a global company through acquisition and product enhancement. It's crazy. But that's just one example of how the U.S. has taken over the world with respect to business. So I'm an incredible bull. I think that, in the end, America wins. Go America.
We are way over our time. And Frank, I want to get to the, you deal with alternative assets as such. I'm going to postpone that until our next session, if that's okay with you. And but I do have one final question to all of you, and that is, with a change in the administration, it would appear that there might be a change in the attitude toward mergers and acquisitions. Will that
Yes.
make any kind of an impact at all in the coming year?
And coming from the alternative asset class, I hope so.
Yep.
As somebody that depends on small to medium sized businesses that make about half of my portfolio getting bought, absolutely.
Totally agree.
All right. Oh, that was good. I love that one, Michael. All right, we will continue our look at investing in the economy in future editions. And I ask that if you are watching or listening to this program, that you hit that like or subscribe button on whatever platform you happen to be watching the program or listening to it on. But for right now, thank you for joining us, and especially thank you for joining us all year. We're going to resume our Bowl of Bearing You next year, 2025, and we will see you then. Thanks for watching.